Inflation is eating away at your savings. Every day, your $100 buys less and less. Feeling helpless? There's a way out. In this video, we will reveal 3 powerful strategies to outmaneuver inflation and turn your $100 into a future-proofed $10,000. We'll explore unconventional methods that traditional financial advisors won't tell you about and teach you how to turn the tables on the economic game. So stay tuned and don't let inflation steal your dreams. Number 1. Invest in low-cost index funds. Putting your money into low-cost index funds like SPY is a tried-and-true method for steadily growing your wealth over time, thanks to the magic of compound interest. This investment strategy packs a punch with benefits like diversification, minimal fees, and the potential for solid long-term gains. Index funds are investment tools designed to mirror the performance of a specific market index, such as the illustrious S&P 500. Unlike actively managed funds where professionals handpick individual stocks in hopes of beating the market, index funds take a more hands-off approach by simply tracking the index they're based on. This passive strategy often translates to lower fees, since there's less need for intensive research and frequent trading. One of the go-to choices for many investors is the SPDR S&P 500 ETF Trust, SPY, a popular index fund designed to mirror the price and yield performance of the S&P 500 index. This index, comprised of 500 of the largest publicly traded companies in the U.S., spans various sectors and industries, making it a comprehensive snapshot of the stock market. By opting for index funds like SPY, investors get exposure to a broad spectrum of the market with just one investment. This diversification is a powerful tool, spreading out risk across multiple companies. So if one company underperforms, gains from others in the index can help cushion the blow. Plus, since the S&P 500 is made up of big-name, stable companies, the overall risk associated with investing in the index is relatively low compared to picking individual stocks. Index funds are renowned for their low expense ratios, the annual fees they charge to cover operating costs. Unlike actively managed funds, which involve frequent buying and selling of stocks, index funds passively track an index. This hands-off approach means their expense ratios are typically much lower, allowing investors to keep more of their returns rather than losing them to fees. Investing in index funds such as SPY hinges on the power of compound interest. This concept involves reinvesting the interest earned on an investment, leading to exponential growth over time. As the investment grows, so do the returns, creating a snowball effect that can dramatically boost wealth accumulation in the long run. Let's break down the magic of compound interest with a simple example. Imagine an investor puts $100 into an index fund like SPY every month, and this fund earns an average annual return of 7%, compounded annually. Over 10 years, the total contribution would add up to $12,000, $100 per month for 12 months over 10 years. But here's where it gets exciting. Thanks to compound interest, that investment would balloon to around $17,280 by the end of a decade, assuming no withdrawals were made. And the longer you let compound interest work its magic, the more impressive the results become. Over several decades, the growth potential of the investment is truly something to marvel at. It's this long-term perspective that's key for investors looking to steadily and reliably build wealth over time. Additionally, diving into index funds such as SPY provides a straightforward and accessible avenue for investment, drawing the attention of both newcomers and experienced investors. With numerous brokerage platforms offering seamless access to index funds, investors can begin with modest sums of money and steadily ramp up their investments. However, it's crucial to recognize that despite their appeal, index funds carry inherent risks. Market instability, economic recessions, and geopolitical shifts can all sway the performance of index funds. Nevertheless, for investors with a patient outlook and a long-term investment strategy, these ups and downs often balance out in the end, paving the way for consistent growth. Number 2. Explore dividend investing with real estate investment trusts, REITs. So now let's delve into the second investment strategy, dividend investing with real estate investment trusts. This approach provides investors with the opportunity to generate passive income through regular dividend payments while also benefiting from potential long-term capital appreciation. Real estate investment trusts are companies specializing in owning, operating, or financing income-generating real estate across various sectors, such as residential, commercial, industrial, and healthcare. Mandated by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, REITs stand out as an appealing choice for investors seeking regular income streams. Investing in dividends through REITs presents several advantages. Firstly, it grants investors exposure to the real estate market without the need for direct property acquisition or management. This setup allows investors to tap into the income potential of real estate without the burdens associated with property ownership. Moreover, REITs offer diversification within the real estate domain. By investing in REITs, investors gain access to a diversified portfolio comprising properties across different regions and sectors. This diversification serves to spread risk and mitigate the impact of any single property's performance on the overall investment. Thirdly, REITs typically offer attractive dividend yields compared to other investment options, such as bonds or traditional dividend-paying stocks. The steady stream of dividend income can provide investors with a reliable source of passive income, making REITs particularly appealing for retirees or those seeking supplemental income. Now let's explore 3 specific REITs that have a track record of consistently paying dividends and increasing their dividend payments over time, earning them the title of Dividend Aristocrats. Realty Income Corporation. Realty Income Corporation, often referred to simply as Realty Income or the Monthly Dividend Company, is one of the most well-known and respected REITs in the market. Realty Income primarily invests in freestanding, single-tenant commercial properties leased to a diverse group of tenants, including retailers, convenience stores, and pharmacies. Realty Income has a long history of paying monthly dividends to its shareholders, making it an attractive option for income-oriented investors seeking regular cash flow. The company's portfolio of properties is carefully curated to include high-quality tenants with long-term lease agreements, providing stability and predictability to its dividend payments. Furthermore, Realty Income has a strong track record of increasing its dividend payout annually, earning it the distinction of being a dividend aristocrat. This commitment to dividend growth has made Realty Income a favorite among income investors seeking reliable, growing income streams over the long term. Number 2. Essex Property Trust, Inc. Essex Property Trust, Inc. is an REIT that specializes in the ownership, acquisition, development, and management of multifamily apartment communities in select West Coast markets. Essex's performance consists of high-quality apartment properties located in desirable locations with strong demographic trends and economic fundamentals. As a leading multifamily REIT, Essex Property Trust generates steady rental income from its diverse portfolio of apartment communities. The company's focus on high-demand markets with limited supply helps support occupancy levels and rental growth rate, contributing to its consistent cash flow generation. Essex Property Trust is committed to returning value to its shareholders through regular dividend payments. The company has a history of increasing its dividend payout over time, reflecting its commitment to creating long-term shareholder value through dividend growth and capital appreciation. Federal Realty Investment Trust, FRT. Federal Realty Investment Trust is an REIT that specializes in the ownership, management, and redevelopment of high-quality retail properties located primarily in densely populated urban and suburban markets. Federal Realty's portfolio includes shopping centers, mixed-use developments, and lifestyle centers that cater to a diverse range of tenants and customers. With a focus on prime retail locations and a tenant roster that includes leading national retailers and specialty stores, Federal Realty generates stable rental income from its well-positioned properties. The company's strategic approach to property management and leasing helps drive foot traffic and sales for its tenants, enhancing the value of its portfolio. Federal Realty is committed to delivering value to its shareholders through consistent dividend payments and long-term dividend growth. The company has a track record of increasing its dividend payout annually, reflecting its dedication to providing shareholders with a reliable and growing income stream. Number 3. Consider option trading. Now let's dive deeper into the third investment strategy, option trading. Option trading offers investors the opportunity to potentially achieve higher returns through strategic bets on the price movements of underlying assets. While option trading can be complex and risky, it also provides unique opportunities for those willing to learn and execute disciplined trading strategies. Options are like the financial Swiss Army knife, deriving their value from assets like stocks, indexes, or commodities. There are two main flavors, calls and puts. A call option gives you the right, but not the obligation, to buy the asset at a set price within a certain time frame. On the flip side, a put option lets you sell the asset within that same time frame. Option trading is all about playing the market swings. Traders dive in, buying and selling contracts, hoping to cash in on shifts in the underlying asset's price. There's a whole toolbox of strategies to choose from, whether it's snagging calls or puts, selling covered calls, or diving into more complex setups like straddles and strangles. What makes options so appealing? Leverage. With just a small chunk of change, investors can control a much bigger slice of the asset pie. But here's the catch. That leverage works both ways, magnifying both the highs and the lows. So while option trading can offer juicy returns, it's also riskier than sticking to plain old stocks. Still, with a careful eye on risk and a solid grasp of the strategies, savvy investors can navigate the option market and potentially rake in some serious gains. Let's explore two common option trading strategies, buying calls or puts. One of the simplest option trading strategies is buying calls or puts. A call option gives the holder the right to buy the underlying asset at a specified price within a certain time frame, while a put option gives the holder the right to sell the underlying asset at a specified price within a certain time frame. When buying calls, investors anticipate that the price of the underlying asset will rise above the strike price before the option expires, allowing them to profit from the price increase. Conversely, when buying puts, investors anticipate that the price of the underlying asset will fall below the strike price before the option expires, allowing them to profit from the price decrease. Buying calls or puts can be a straightforward way to capitalize on short-term price movements in the underlying asset. However, it's essential to consider factors such as a time decay, implied volatility, and the likelihood of the option expiring in the money. Selling covered calls. Selling covered calls is a popular option strategy used by investors seeking to generate income from their existing stock holdings. In this strategy, the investor sells call options against shares of stock they already own, hence covered calls. When selling covered calls, investors collect a premium from the buyer of the call option in exchange for granting them the right to buy the stock at a specified price, the strike price, within a certain time frame. If the stock price remains below the strike price at expiration, the option expires worthless, and the investor keeps the premium as profit. Selling covered calls can be an effective way to enhance the yield of a stock portfolio, especially in a sideways or slightly bullish market environment. However, there is a risk of capping potential gains if the stock price surpasses the stock price of the call option. So that's all for this video. We will be back with another amazing video to boost your wealth, so stay tuned.